Have you ever wondered how Wall Street pros figure out what a stock is really worth? Well, they use this incredibly powerful technique it's more of an art than a science. And it all kicks off with a question that's actually way simpler than you might think. So let's just forget about stocks for a second. Imagine you're trying to buy this house. How in the world would you figure out a fair price? I mean, you're not just going to guess, right? Of course not. You do what we all do. You'd look around the neighborhood and see what the other houses are selling for. And right there, that's pretty much the whole secret. The exact same logic, believe it or not, applies to stocks. When you're pricing a house, you check the neighbors. When you're pricing a stock, you check its peers, the other companies on the same block. It's all about finding the right context. Now, this common sense way of thinking has a fancy name on Wall Street: comparables analysis. Or if you want to sound like you're in the know, you just call it comps. This is the bedrock of a method called relative valuation, and it really all boils down to one simple core idea. And here's that big idea. Similar companies should, in theory, have similar price tags. It just makes sense, right? So by lining a company up against its direct competitors, you can get an almost instant feel for whether it's trading at a premium, maybe a discount, or if the price is just right. Okay, so how do we actually do this comparison? We can't just go with a gut feeling. We need real numbers, specific metrics to look at. And to do that, we have to open up the analyst toolkit and grab the right tools for the job. And those tools are called valuation multiples. Just think of these multiples as different kinds of financial price tags. Now, the PE ratio, that's the famous one, right? It compares the stock price to the company's profit. But really smart analysts, they look way beyond that. They might use a price-to-sales multiple for a company that isn't even profitable yet, or maybe EV/EBITDA to get a cleaner comparison that isn't all skewed by debt. Each one of these tells a slightly different part of the story. Okay, now hold on. Before you even think about calculating a single ratio, we've got to talk about the single most important step. This is the one thing that can make or break your entire analysis: choosing the right companies to compare against. Seriously, getting this peer group right is everything. Let's go back to our house analogy. You wouldn't compare a little bungalow out in the suburbs to a giant mansion in the middle of downtown, would you? The context would be totally wrong. It's the exact same for stocks. You have to be comparing apples to apples, and that means being super careful about who you put in that peer group. So how do you do it? Well, there's a pretty straightforward 4-step process. First, are they in the same industry? Are they playing in the same sandbox? Second, size. I mean, a global giant and a tiny startup just aren't comparable. Third, business model. A software company that sells subscriptions is totally different from one that sells hardware. And fourth, growth. A super fast-growing company should be compared to other fast growers. You got to hit these 4 points for the comparison to be valid. And here's a little pro tip. You don't need to find 100 companies. A really solid rule of thumb is that a well-chosen group of about 5 to 10 peers, well, that's usually more than enough to get a really meaningful comparison. It's all about quality over quantity here. And this quote right here, it highlights a massive trap. A high-growth tech startup that's burning through cash to grab market share is playing a completely different game than a stable, mature company that pays out dividends. Their valuation multiples are going to look wildly different, and for very good reasons. If you mix those two up, your analysis is just flawed from the very start. Okay, so you've picked your peer group, you've calculated the multiples. Now for the fun part, figuring out what it all means. So are you looking at a premium company, or is it trading at a discount? Let's see what that actually looks like. Take a look at this chart. Our target company here has a PE ratio of 25. The average for its peer group is 20. So this tells us the market is willing to pay more for each dollar of our company's earnings. In other words, it's trading at a premium. But, and this is so important, that number, 25, that is not the answer. It's the next question. And that question is always, why? If a company is trading at a premium, is it because it deserves it? Maybe it's growing faster or has a stronger competitive advantage. And if it's trading at a discount, is it a hidden gem the market has overlooked? Or is there a real problem, like weaker fundamentals or higher risk? The multiple is just the starting point of your investigation, not the conclusion. So, after all that, what's the big takeaway? Well, it's absolutely crucial to remember that even though we've been using numbers and charts and all that, valuation is not a simple math problem. It is so much more than that.
Comps are an incredibly powerful tool because they give you context. They anchor your analysis in what's actually happening in the market, but they will never, ever give you a single magical right answer. That's why the best analysts never use just this method alone. They always combine it with other techniques to build a full 360-degree picture of what a company is truly worth.
And ultimately, that's your job as an investor. The numbers, they aren't the answer. They're just the clues. They're the breadcrumbs that start you on an investigation. They point you in the right direction and tell you what questions you need to ask. The real art, well, that lies in taking all those clues and piecing them together to uncover the real story the market is telling you. So are you ready to start digging?